Hey everyone, welcome to The Explainer. I'm really glad you're joining me today because if you're tuning in, you already know that global markets don't just move in a vacuum. Today, we're breaking down a highly complex, multi-layered financial briefing that maps out exactly how three massive macroeconomic forces, the explosive AI boom, intense geopolitical friction, and a looming energy crunch, are basically on a crash course with one another. My goal here is to take these intricate models and make them clear, accessible, and actionable for you. All right, let's dive right in.
So here is our game plan for today. Number 1, the market scorecard. Number 2, Force 1, the AI boom. Number 3, Force 2, macro friction. Number 4, Force 3, the energy crunch. Number 5, the inevitable AI energy collision. And finally, number 6, our Q3 2026 strategic posture. Let's get to it.
Part 1. The Market Scorecard. Let's look at the quantitative reality.
Just look at the sheer resilience we're seeing right now. The Dow is casually crossing that 50,200 mark. The S&P and NASDAQ comfortably in the green, and it's mostly being dragged upward by the information technology sector, which is up around 2.4%. We've got heavy hitters like Intel jumping, 8.6%? But, and here's the catch, right alongside all this tech euphoria, take a look at the commodities. Brent crude is sitting at a one-month high of over $91 a barrel. Gold is up too. So what's that actually telling us? The market is aggressively pushing forward, sure, but it is absolutely pricing in some serious underlying friction and real-world scarcity.
Moving to Part 2, Force 1, the AI boom, our massive engine of tech.
Right now, the market has tunnel vision. It is entirely fixated on hyperscaler spending. Markets recently completely shrugged off geopolitical fears just to buy up chip makers, pushing the semiconductor index up 5%. And we are right in the thick of a massive earnings barrage, right? Alphabet and Tesla are reporting, followed closely by Intel, Microsoft, Meta, and Amazon. And honestly, the single unifying question driving every ounce of this price action is this: are these hyperscalers going to report large enough capital spending plans to keep the AI trade alive? Because make no mistake, their infrastructure spending is the absolute lifeblood of this rally.
But you know, the landscape of this whole AI boom is actually starting to fracture. On one hand, we've got Western hyperscalers. Think OpenAI, Anthropic, Google. Their structural reality, a massive dependency on incredibly expensive, cutting-edge hardware. But then, look over at the emerging Chinese AI players, companies like Alibaba and Moonshot AI. They're engineering these low-cost models specifically designed to just completely bypass advanced chip restrictions. And get this, they are claiming performance parity. The reason the market cares so much is because if these low-cost models actually succeed, they actively dampen global semiconductor demand. That's a tension that is already freaking out Western executives enough to literally double their lobbying budgets.
$7 trillion. I really want you to let that number sink in for a second. To put that into perspective, that's roughly the GDP of Japan and Germany combined. According to deep modeling data from Morgan Stanley, this is the projected total opportunity for retail AI by the year 2030. It represents a massive compound annual growth rate jump to 9%, which would drive online sales to 27% of all retail. But how on earth do we actually reach a number that's staggeringly large?
Well, we get there through a fundamental shift in how we buy things. Right now, in Phase 1, we're living in what we call the era of the collaborative cart. 61% of parents currently let their kids add items directly to online carts for things like back-to-school shopping, which, by the way, totally explains those random dinosaur toys showing up at your front door. The human is still in the loop. But let's fast forward to Phase 2, projected for around 2030. This is the era of agentic AI purchasing. Algorithms are going to evolve way beyond just recommending products. They're actually going to execute automated purchasing. The AI will completely remove the human from the final checkout decision. And that right there is the $7 trillion structural shift the market is pricing in.
All right, Section 3, Force 2, macro friction, the heavy realities of geopolitics and the economy.
Take a look at this figure, $37.5 billion. This represents the mathematically updated projected cost of the US-Iran war. That is a full $9 billion higher than earlier projections, and it is actively sending shockwaves through the oil markets. There's a whole mix of factors driving this massive price tag. You've got the persistent threat of Iranian ballistic missiles, Israel's current holding pattern to preserve diplomacy, and of course, the market is pricing in a Trump-approved nuclear deal with Saudi Arabia. Every single one of these physical world tensions is acting like a direct, heavy tax on the global economy.
So how do analysts even begin to navigate this?
They use models like this one from Signum Global. This is the Taco Volatility Cycle, which maps out geopolitical tension and rhetoric. And yeah, Taco stands for the Trump always chickens out theory. But regardless of your politics, the mathematical modeling here is what we actually care about. It forecasts that markets should expect maximum rhetorical escalation to hit a 2.3 to 3.4 standard deviation peak right around July 26th before it eventually de-escalates. If you're navigating these markets, this model gives us a highly specific temporal warning for peak volatility.
But hey, the friction isn't just geopolitical, right? It's heavily monetary too. On one side of the scale, we've got 30-year Treasury yields pushing real yields to their highest levels since all the way back in 2008. And on the flip side, we have $348.5 billion currently locked up in private equity zombie funds, which is just tying up vital investor liquidity. So, the absolute crucial point to understand here is this. Rising yields reflect creeping doubts about government debt, which actively raises the risk-free bar. Tech stocks, which rely on these distant, long-duration cash flows, now have to clear a much higher hurdle just to justify those massive valuations.
Which brings us to Section 4, Force 3, the energy crunch. Let's talk physical infrastructure.
I want to zero in on this incredibly stark warning from Chronometer Partners. They're pointing out something a lot of people are missing. Natural gas currently makes up over 40% of U.S. power generation. And because domestic shale production has been so incredibly plentiful since roughly 2010, the market has essentially been lulled to sleep. It's in this highly dangerous state of complacency. You've got investors cheering on massive AI compute expansion, but they're entirely forgetting that this illusion of infinite energy abundance, it's about to end abruptly.
And the timeline arriving at 2028 shows us exactly when that illusion shatters. Total production is capping out around 132 billion cubic feet per day. Why? Well, it's a mix of well pressure degradation and these agonizing multi-year environmental permitting delays. But at the exact same time, locked liquid natural gas exports are just growing rapidly. The math here is completely undeniable. By the second half of 2028, we hit a massive structural deficit of 5 billion cubic feet per day. We literally, physically will not have the gas to meet the projected demand.
Section 5. The AI energy collision. This is where Force 1 finally meets Force 3.
This is the absolute critical nexus of our whole briefing. Think of it like this. On one side, you have the unstoppable force of hyperscaler compute demand. On the other side, the immovable object of that 2028 natural gas supply deficit. Right now, energy costs make up roughly 10% of total hyperscaler compute budgets. But when these two massive forces inevitably collide, that energy cost is projected to double, maybe even triple, hitting 20 to 30% of their total budgets by 2029. The profit margins of the absolute biggest tech companies in the world are about to get severely squeezed by very real, physical commodity constraints.
Finally, Section 6. Q3 2026 Strategic Posture. Let's get into some actionable intelligence.
All right, let's break down this energy trade matrix. The central takeaway you need to internalize here is that the true AI trade now strictly requires an energy hedge. The clear winners? Upstream natural gas producers with high rock quality who can extract quickly. Think players like Exbond Energy and Range Resources. The long-term winners are definitely the alternatives, solar infrastructure and nuclear suppliers like Cameco and BWX Technologies. And on the losing side, you're looking at infrastructure tied to prohibitive gas costs like Caterpillar and Bloom Energy. And most importantly, any unhedged tech hyperscaler. They're staring down the barrel of severe margin compression.
To wrap up our strategic posture, you have got to align your allocations to these structural realities. First, play some defense. Hedge that July 26 volatility window and seriously account for those rising long bond yields. Second, be highly selective in tech. Don't just blindly throw money at the Magnificent Seven. Closely evaluate the very real threat of those Chinese open-source AI models. And finally, go on the aggressive in energy to front-run that 2028 supply cliff. I want to leave you with one final, provocative thought to chew on today. If the infinite, limitless potential of artificial intelligence is ultimately completely reliant on a physical, metal and wire energy grid that is mathematically running dry, is your portfolio actually prepared for the harsh reality of 2028? Thanks so much for joining me on this explainer. Keep learning, and I'll catch you next time.